I don't normally invest in a lot of mega cap stocks, but I always said if I had to choose one of those mega caps, it would actually be Google stock. So in this video, I'm going to explain why I would choose Google over any other type of mega cap or very large cap stock, talk about my valuation model and why I don't own Google right now and when I'm exactly looking to buy it. Now, Google stock was over $150 at the beginning of the year, and now it's sitting at $107. Now, another large cap or mega cap I would be interested in buying is actually Meta. Why? Because mostly in my strategy, I'd like to buy, companies where there's some extreme bad sentiment or a big misunderstanding around a certain company or a certain industry. And that's where normally I find more value by buying mostly hated stocks and kind of sell them whenever everybody loves them again. And of course, Meta is hated much more than Google, but I don't own Meta and I don't own Google, but Google is a pretty interesting one for the long term. So I'm not gonna waste your time and talk deeply about Google as most of you are familiar with it. So again, I hope you enjoy this video. Now, the best thing about owning Google stock is that it has a very wide and deep moat. Why is a moat so important in investing? I would like to quote Warren Buffett in a video that I watched actually a couple of days ago, and he was saying that if a business can come to your industry and kind of be a threat to your industry, kind of really compete with you very, very fast, you will lose your moat just as fast. And you could maybe think about it a little bit in terms of, Meta. For example, what happened with TikTok. I'm not saying TikTok is taking all over Meta, but of course you could kind of respect really how fast TikTok emerged and competed with Facebook. And this is nothing against Facebook, but I'm just saying that this is what happened. Now, in terms of Google, I don't really see it personally happening, especially competing, for example, with Google search. I mean, 5-10 years from now, I would pretty much think that people will still be using Google search. I think people will still be watching YouTube, as for example, TikTok doesn't really compete with YouTube, as YouTube is more educational and it's more longer, kind of 10-15 minutes type of videos. TikTok is more entertainment and it's more shorter term type of videos. So it's totally different stuff. So they own Google Network, Google Advertising, Google Services, and one of my favorites, which is actually Google Cloud. And this is one of the fastest growing segment of their business model, and it's likely going to grow much faster in the future. Now, the bad thing about Google Cloud is that it's losing money, and it's losing actually more money kind of quarter on quarter. I would personally prefer if Google Cloud, loses less money over time, but it's actually losing more money over time. And the same thing with their other bets, they're around 1.4 billion, now it's around 1.7 billion. Mainly because Google likes to invest in growth. They like to sacrifice kind of, shorter term type of gains for more sustained, longer term type of gains. And this is the way it is. But I believe Google Cloud is going to be a profit machine and a free cash flow machine going into the future of this decade. And it's in a high growth industry. And I do really like Google Cloud. Now, looking in a little bit deeper was, again, one of the best things with Google is the amazing balance sheet, over 124 billion or $125 billion of cash. They can use their cash balance to pretty much, pay all their total liabilities and have around $24 billion of cash left. Again, this is an amazing moat within the business, and it does have an amazing fortress balance sheet for Google stock. Looking in a little bit more in terms of valuation, now we're sitting around 19.5 times earning, and looking at the past 10 years, this is one of the lowest Google actually ever traded. And if you actually compare it with other type of stocks and large cap stocks, it's one of the cheapest between all of them. And I would personally buy Google over Apple pretty much any day. I think Google is pretty undervalued compared to many other stocks. But again, there's a trick with that, which I'm going to talk about a little bit later. So not only you're getting one of the cheapest valuations on a historical basis, but you're also getting pretty amazing share buybacks, which the company has been repurchasing aggressively, quarter over quarter, year over year. The share counts continue to go down, and now they have a buyback program around 4% of the entire company in just 1 year, which is going to create a lot of shareholder value for long-term Google shareholders. Now in this video now, I'm going to really talk about why I don't own Google. I mean, everything sounds so nice, a big moat, growth with Google, a decent valuation, amazing balance sheet. So why don't I own Google yet? And this is when I'm going to go with the valuation model to kind of show you why I don't own Google stock. Now looking at the 2022 revenues, they're expected to earn around 283 billion, and I put in 10% revenue growth over the next 5 years. Now it's around 12% expected revenue growth from the analyst over the next 5 years, but I put in 10%, which is around a 2% less, just in case, maybe the bad economic environment continues, ad spending is gonna continue to go down. Google wasn't very affected now, but it's eventually going to be affected in the future, so those estimates may come down a little bit. So actually the 19 PE that we're actually seeing with Google, it could be, a little bit off, mainly because if the analyst, downgrades the estimates, the PE is gonna be 21 to 22. But nonetheless, it's much lower than historical average. So with 10% revenue growth and a 25% net income margin, which is the net income margin of Google right now, you get around $103 billion of net income in 2026. Now going down a little bit more, the PE ratio I put in of 25, and this is where the trick actually is. But I put in 25 mainly because it's close to the historical average of around 23.5. So if we put in a 25 PE, all right, we get around a $2.6 trillion market cap in 2026. That's around an 85% upside, or 13% compounded every single year for the next 5 years. Now, if you add a little bit of buybacks, 3 to 4% of value every single year, you could end up with more than 100%, meaning you could maybe double your money over the next 5 years. Now, you may say, that's amazing, but why don't you own Google stock? Well, for one simple reason. Now the growth is around 10% from now till 2026. Now, after 2026, will Google still be able to grow 10%? Now, I'm not saying, that it's not going to grow anymore, but whenever companies get more mature, the growth starts to slow down. It's just, basic economics. Whenever Google started out, it was a high grower, and then slowly those companies start, growing less and less and less. For example, after 2026, if Google grows, for example, 6 to 7% instead of 10 to 12%, this would be a much lower valuation in terms of the PE ratio. So the 25 PE ratio could be maybe off 5 years from now. Now it maybe look like a deal, but if you think about it 5 years from now, will Google still be able to do the same type of growth? So if Google traded at 20 PE 5 years from now instead of 25, we look at my valuation model, the upside is only 48% over the next 5 years. And so if Google basically just trades the same multiple that it is right now, which is around 20 times earnings, it would be only 48%. Now that may not happen. I could trade at a 25 PE, which is a little bit more fair. That would be close to 100%. But that's not a big enough margin of safety for me to invest into Google. Because what if the PE is, 21 or 20? What if it's, 19 PE? What if we have, higher interest rates, more in the future, and then normally the PE ratios reset to a lower multiple? Or what if the growth actually slows down 5 years from now as Google and Google Cloud kind of becomes a little bit more mature, which is normal, nothing wrong with Google. This is just a normal cycle of all companies. This way, I would not be making a lot of returns with Google stock. So I am not buying Google right now, although it pretty much looks like a deal. So if I really was a very long-term investor and I only kind of wanted to buy an index fund or Google, I would choose Google and get around a 13% compounded every single year. But because my strategy is more around, hated stocks and, very undervalued, small caps or, mid caps, but they are not covered by a lot of analysts, which kind of normally leaves more room for error and a potential, more returns for the future. I'm not really buying Google. But if I was a conservative investor and I don't have very high risk tolerance, I would personally buy Google right now in dollar cost average down. But for me to buy Google with a decent margin of safety to double my money over the next 5 years, I would need Google under $90 per share. So if Google falls under $90, $80, $85 per share, I would open a position and kind of cost average into it if it goes down or if it goes up. But I would only start a position only under $90 per share. But if I don't have any other option and I'm a very long-term investor with a very kind of low risk tolerance, I would personally buy Google right now and dollar cost average into it as it goes down. So yes, I personally think Google is a buy, but it just depends on your risk tolerance, and it's getting pretty close to fair value for me. So this is my video for today. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.